The most recent data has shown that Australia's economy grew by 3.6% in annual terms. But will inflation and rising interest rates put an end to that? Well, that's what I'm going to discuss in this week's Property Insider chat with Dr. Andrew Wilson. We're also going to talk about the outlook for interest rates and inflation, and maybe it's going to be different to what many of those economists who are suggesting we're going to have some challenging times are predicting. We'll go into a deep dive of what's happening, but if you want to keep up to date with what's going on in our property markets and the economy, please subscribe to this YouTube channel and click the little bell icon so we can update you each time a new show comes. Our economy roared, but will inflation and rising rates put an end to that? The most recent data showed that Australia's economy grew by 3.6% in annual terms. As the lockdown shackles loosened, Australians bought more shoes, more clothes, more coffees, and they helped the economy grow by a healthy 0.9% in 3 months to June 30th. Unfortunately, this latest data we've just received is quite old now. It's quite lagging, isn't it? But the Reserve Bank has raised cash rates 1.5 percentage points since then. So is the outlook souring with inflation and rising interest rates starting to eat into our household budgets? What does this mean for our economy and our property markets? There's some of the questions I want to ask Dr. Andrew Wilson, Chief Economist of My Housing Market and Australia's leading housing market economist. We're also going to talk a bit about the outlook for interest rates, the latest rental data from Dr. Wilson's My Housing Market, and also what our auction markets are telling us. And it's not what some of those property pessimists were predicting. Hi, Andrew.
Good morning, Michael. Good to be here again, and some more interesting data this week, of course. And we are now well and truly into spring. So happy spring to everybody.
Well, the spring property market's doing well, and we'll get onto that. But let's just talk about the economic data first, because the latest ABS data published last week revealed Australia's economy grew 3.6%, but that was to the 3 months ended June 2022. And this was higher than the long-term averages, but it was mainly driven, Andrew, as I read it, by higher household consumption and stronger exports. The massive number of Australians spent their lockdown savings. They went on holidays, they ate out. I know I did the same, and that drove our economy. But how long can this go on for? We can't keep spending our savings. What's going to happen with interest rates, and how is the rising interest rates going to affect our economy moving forward?
Well, the GDP numbers were a little bit higher than for the March quarter, 0.9% over the quarter, which I think is not too bad. I wouldn't get too excited about it. It's around about the numbers we were having pre-COVID. But of course, there are conditions that are different to pre-COVID conditions that are driving GDP growth at the moment. We had very strong terms of trade. Of course, as you mentioned, spending continued. We're still out there spending. And I think you're right. I think people are taking holidays and continuing to get on with life, I suppose. A little bit of relief after lockdowns are finished, and we're a lot more circumspect in terms of controlling COVID. Just been announced, of course, that you don't have to wear a mask on an aeroplane anymore, which I was coming back from Noosa Heads just the other day, and the first time in a long time I didn't have to wear a mask on the planes. We are normalising, and I guess that reflects itself in still strong consumption in terms of our GDP numbers. And the other factor was quite strong terms of trade. We're doing well as an exporting nation, particularly with our resources and our agricultural exports as well, given the shortage or higher demand and constraints with delivery, etc., that are pushing up prices. So volumes and prices were up for our exports, and that contributed also significantly to GDP. But the bottom line is that I guess our GDP grew where the US GDP fell. So we're doing pretty well. And again, we're doing pretty well all through this inflationary period compared to other similar economies, whether it be in terms of GDP or the actual inflation rate on a comparative basis, or other factors such as wages growth. Another good result for Australia going forward.
Andrew, the Reserve Bank predicted that GDP is going to start slowing now. I mean, that's what it wants, and they're suggesting it's going to slow to 1.8% in annual terms by the June quarter in 2024. That's roughly half of what it is now. But also the Reserve Bank Governor, Philip Lowe, hinted he's ready to take his foot off, well, maybe at least one of the feet on the brake. I think he had both feet on the brake pedal in the last little while. Is he going to wait until it's clearer whether the 5 straight interest rate rises are going to have the desired effect? Because there is a lag on how long it takes to slow the economy and slow our spending.
Yeah, but again, Michael, his problem is that the data is backward looking. You don't want to be saying, oh, well, the inflation has eased, so we can stop raising interest rates. But in the meantime, you've been raising interest rates, which is actually contributing to higher inflation. I think Australia's been well positioned, good policy, good luck, who knows, but certainly in comparison to other similar economies. And I think that we can afford to be just a little bit more optimistic now going forward. And I think that does mean that we can afford to start easing back on those interest rates increases, and maybe the next one could possibly be just back to the 0.25% and wait and see what will happen going forward, because we are moving towards the end of the year, Michael. And of course, really November is the last action day, or the November meeting is the last action day for interest rates, because December really is not much good in terms of its effect, because we're all in holiday mode for a couple of months till the bank meets again next February. But as I said, I think that, signs are certainly improving, Michael. I think we can be more optimistic now. And I've been saying this now for a month or so, that the outlook for inflation and interest rates is that we may peak lower than expected and sooner than expected.
And when that happens and people recognise, hey, this is as bad as it gets. Hey, our interest rates, our mortgage rates are not going to get any higher. I can see them getting into the property markets, and the pent-up demand that is now being created is going to ignite our markets. Not to the extent it did a year or two ago after our COVID lockdowns, but life will get back to normal in property.
Yes, that's right, Michael. And those key drivers of inflation, which the Reserve Bank should be focusing on, which are more real time, certainly reflect that the price of oil has fallen sharply and continues to fall. Of course, that can be a very volatile commodity, oil prices, but certainly the trend is clearly downwards now. And also, the My Housing Market Building Cost Index is also falling on a monthly basis now. So house building costs are starting to ease. I mean, it's still high compared to a year ago, but the trend is downwards there. And of course, inflation is all about the growth from period to period, not the level of prices from period to period.
That's a point that I think a lot of people actually forget, that it's the change in growth in that period. Now, one of the factors that we keep an eye on is home lending, because it's a leading indicator. When people get their finance pre-approved, they're clearly looking for property, and home lending fell over the July period.
Well, no surprise, Michael. Home lending again down and down sharply, but the levels are still certainly high compared to the pre-COVID home loan activity. And we've come through a very strong period of growth. A lot of that pent-up demand through COVID has been released. Also, lower interest rates and stimulus packages that activated home buying. And and FOMO, of course, was a significant factor, fear of missing out. So I guess we're getting back to more of a normalised environment for home lending. And when we look at affordability measures in terms of the proportion of the average income that the average loan is taking up, that's rising significantly. So affordability has certainly also pushed buyers out of the market. But this is the nature of the cycle, Michael. Once prices get to a certain level, we can't afford to pay anymore, and a lot of demand is satisfied and buyers are sidelined. So no surprise that home lending levels have fallen, but they're still in real terms quite high compared to the pre-COVID period, Michael.
I know once a month My Housing Market brings out their rental reports, and over the last little while, houses have had very strong rental growth because vacancy rates have been low, but the apartment market, the unit market's now starting to pick up, Andrew.
Yes, Michael, that's been the trend over recent months, is that we've just seen an easing in house rents, and I think that's all about affordability. House rent increased remarkably over the past year, and it just gets to a point where tenants can't pay anymore. And I think what we've seen as an offset to that is higher unit rents. Rents are continuing to rise, and I think perhaps at some level that represents, particularly in Sydney, the shift from houses to units, because houses have become so unaffordable. And there are obviously fewer houses now available for rent. But there's no doubt that unit rents are rising consistently in most capital city markets. So again, it's underscoring that shortage of dwellings that we have, Michael, and the shift for more affordable dwellings, which of course is units versus houses. And but still, the unit market has skyrocketed in terms of its rental increases over the last year, as well as houses.
Well, with the housing market, I know the My Housing Market house rental figures show that the highest vacancy rate around Australia is Melbourne at 1.2%. And I'm saying highest with inverted commas because really that's a very, very low vacancy rate. There just aren't enough houses for rent. But even when you look at the units, Melbourne again had the highest vacancy rate at 2.3%. But when vacancy rates are 0.5 like they are in Adelaide, 0.8 in Perth, 1% in Darwin, there's just not enough houses. You need available houses as people change their lifestyle, move house, have different requirements. There obviously are long queues for vacant properties at the moment. There are stories on social media of people sleeping in cars and tents, which is terrible if that's really true. But I guess it means that rents have only got one way to move, and that's up, Andrew.
Well, that's right. Absolutely. And when we look at the big picture, Michael, on the supply side, the latest building stats were terrible because they showed a significant collapse in unit development. When we look on the demand side, we've still got to get all those migrants back into the country, and they're going to have to find somewhere to live. So again, it's under supply, high levels of migration with borders opening and low levels of new dwellings, so that can only mean higher rents.
Well, let me tell you what the wrong solution would be, and that's to fix rents, to stop rents going up as the Greens came up with. That's not going to help supply. All that's going to do is push investors out of the market. But I see that they've done that in Ireland and they've done that in Scotland.
Yes, again, we've got to look at the local factors to see what the big picture is there. We've had various rent control mechanisms in various constituencies, Michael. New York's a famous one there because they're always short of property in New York. Their rents have gone through the roof. And that's become very problematic for their rent control properties there because landlords are finding it very difficult to make money. And that's the point you made. If landlords, it's a business like any other business, and if you stop the profit margin by reducing your income, it gets to the point where there are other options. So you only create fewer investor properties or investor appetite for property, which means fewer rental properties. People do end up, unfortunately, sleeping in cars and on the streets because if you just don't have the rental properties, it doesn't matter what you're charging, people have got nowhere to live.
Now, I know every Saturday you work hard analysing the auction results around Australia. You're the first one to release detailed reports every Sunday morning, not just on the state auction results, but you break them down by region and you break them down by houses and apartments, which makes more sense than just an overall result. You report them every Sunday on LinkedIn and we do on Property Update. And the auction markets have started spring with some strength, Andrew.
Yeah, inarguably, Michael, the trend is clearly upwards, particularly in Melbourne and Sydney. And of course, Melbourne and Sydney have led the charge downwards in this correction environment over the last couple of months since interest rates have been rising. But certainly there's a much more positive feel about both the Melbourne and Sydney auction markets. And of course, we know those auction markets are very good forward indicators of what's happening on the ground because they happen from weekend to weekend, whereas the price data and other models of housing market activity lag because you have to take them over a longer period of time, a month or a quarter. So the auction markets certainly in Melbourne and Sydney have picked up recently. We saw quite a 2 weeks in a row with the Sydney market picking up now with a clearance rate over 65%. I think it's important, not just the actual number, but to look at the trend. And the Sydney market has certainly been trending upwards over the last 3 or 4 weekends and is now firmly in that low to middle 60% range. I think just as a rule of thumb, Michael, it's interesting to comment that when we start getting clearance rates around 65%, it's probably the neutral point for prices growth. So I guess the balanced market is, we could say, at around about 65% clearance rates. And once we start moving above there, we start having demand ahead of supply. And I think that's the question. Will we start to see auction clearance rates moving towards 70% through spring, which would be the point where we could start to say that the market is recovering in terms of prices growth? But no doubt the trend is upward in Melbourne and Sydney. Melbourne has actually been quite a resilient performer over the last month or more. It's really been firmly in that low to middle 60% range over the past month. And what we're seeing in Melbourne now is, as we would expect, a big rise in listings. There was a big jump in listings, auction listings on the weekend in Melbourne. So these are tests for the market, whether they can absorb the surge in listings at the same rate as they have been over the past couple of weekends, at least in Melbourne and Sydney. Going forward, we can certainly say that the spring selling season has started as it usually does, Michael, with more buyers and sellers in the market. The smaller markets, we're still seeing Brisbane certainly flatter than where it was, but the surge in migration is certainly ended in Brisbane that created that remarkable drive into the market last year. Adelaide's remained quite stable, certainly still the top performer. And again, the Canberra market not really showing any signs of revival, but it too is in recovery mode or looking towards recovering from what was a very strong period. But more listings to come through shortly, Michael, which will certainly test those early spring markets.
Well, we're into the last quarter of the year. I don't think the dire predictions of substantial drops are going to happen. The market hasn't found a bottom yet, but it's looking for a bottom, isn't it?
Yeah, absolutely, Michael. It's just feeling its way in the bottom, particularly Sydney and Melbourne, which were, of course, the leaders in terms of price declines, which we shouldn't be surprised at because they were the clear leaders in terms of price increases last year. So it's all not working at the same level. But as I said, I think clearly the auction markets are telling us that the market is improving. There's no doubt about that. And it's just a question of whether prices will follow going forward and whether the big picture is whether higher volumes of stock for sale will find higher levels of buyers. And so for interesting times ahead. But certainly, I think the doomsayers will be just perhaps starting to revisit some of their predictions of recent months, Michael.
Well, those predictions of taking a weekly or a monthly figure and multiplying it by 52 or by 12 doesn't really make sense, as we're finding that the slowing down of our markets, which are a real thing and happen every cycle, the slowdown is starting to slow down.
That's right, Michael. And this could be, and I think we've discussed this could be quite a shallow correction phase. And we are desperately short of housing in this country. And that's the bottom line for any economic conundrum is the nature of supply and demand. And there's no doubt that we just don't have enough houses.
Well, I look forward to catching up with you again next week and looking at all the housing market data. Thanks, Andrew.
Thank you, Michael.